Hello traders, hope you guys are good and welcome to my channel. In today's video, we're going to be talking about imbalances. And this video is a continuation from a video I uploaded on market manipulation. If you still haven't watched that video, a link to that video will be made available in the description box below. Now, by now, you should understand that the market is just a mere exchange between buyers and sellers, or capital is changing hands between buyers and sellers. Whenever you have equal amounts of buyers and sellers in the market, you have a state called equilibrium. Let me just write that down. But in a state of equilibrium, we can't make profit. So for the market to be healthy, price always has to move up and down. Now, if you have unequal amounts of buyers and sellers in the market, you have what we call an imbalance. And by now, whenever you see a sharp rise or a decline in price, you understand that there are unfilled orders. So let me write that down also. Now the market has memory, right? And these unfilled orders act as magnet for price. Volatility is caused by when you have large amounts of orders coming into the market, but low liquidity. And what we also know about these areas where you have this volatility, or the areas where you have a large orders and an area where there's a lot of unfilled orders, we know that these areas are like magnets for price. So the market will eventually go back to these areas either to fill in the orders and reverse, or to grab liquidity from those areas and continue in the direction that it was moving in before it went back to that level. We're going to talk about the three main signs of a large imbalance in the market and how you can use, or how you can place your entries around these levels. Now, this is just a basic introduction. Obviously, there's going to be more detailed content as to how you approach it, using other factors like your multi-time frame analysis, taking into consideration liquidity pools, for example. But yeah, basically, now the best signal for an imbalance in the market, number one, you have gaps. I'm assuming you're not a novice trader and you have noticed that when you have a gap in the market will eventually fill in that gap. Now, gaps are not a common occurrence in the Forex market because gaps are normally an indication of low liquidity. So the Forex market is a highly liquid market. That's why you rarely ever get gaps. Gaps are even more common on exotic pairs than on major pairs. So, like I said, the market will eventually, if price was going down, price will eventually go back to this area and cover this gap over here. Number two signal, the second best, is a Marubozu candlestick. And the Marubozu candlestick looks like this. Here's the characteristics of a Marubozu candlestick. Large candlestick. That's point number one. It's a large candlestick. Let me just decrease the font size. Yeah. Number two has no wicks. Or small wicks, unnoticeable wicks. which often represents so they have no wicks, or if they do have wicks, you find that they have small wicks, which often serves as evidence that during that trading session, there was no opposing force. And this will lead me to my third point. Common during high impact news. Another signal of a large imbalance in the market, the third best signal, is an 80% ERC candlestick. And is similar to a Marubozu candlestick, but the 80% just comes from, it's similar in terms of the fact that it's a large candlestick relative to the candlesticks near it. It's also very common during high impact news, right? So the reason why it's called an 80% ERC candlestick is because with that candlestick type, you have a trading range, meaning the distance between your high and low. Now, with that type of candlestick, the body of that candlestick makes up 80% of that range. That's why it's called an 80% ERC candlestick. It's also a large candlestick relative to the candlestick near it, and what. So this is how you easily spot the large imbalances in the market. Now, where are we going to look for entries? At the source. So this is, most of the time when I'm talking about imbalances, I'm actually not talking about the actual imbalance, but the source of that imbalance. So this is where we're going to be placing our entries. Later on, I'm going to upload a video where I'm going to teach you how to filter out the areas where you're going to find the most profitable signals versus where you're going to find the least profitable signals. So like I said, today we're just doing a basic introduction. I hope you've taken notes. Let me just label here. And then trading range. A range is the distance between and we said with 80% ERC candlesticks, the real body makes up 80% of this range. Now let's go to a live market and we can study how this actually works in a real life situation. So you're on EURUSD on the daily chart, and I just want to go back in time. So I just want to show you some imbalances in the market. Look at this right here. The market eventually went back to fill in the orders that were left here and continued down. Look at this imbalance over here. Market eventually went back into this area to fill in the orders here, right? Let's take a few trades using this knowledge. So this is your area of liquidity. You have equal lows here. You know that the market will eventually come here to take out stop losses. Here you had a swing high, and now you just experienced a break of structure. Now the market is going to create a new high and come back, find an order block right here, and then does create a new low. You see that with this break of structure, you have this Marubozu candlestick, right? This is your imbalance. So on this area over here, orders weren't filled. But like I said, where are we going to place our entries? On the source of that imbalance. Now you're going to place your limit order at the open of that candlestick before your large imbalance, and you're going to place your stop loss below, a few pips below the low of that institutional candlestick. And then how are we going, or where are we going to place our take profit? Usually we look for high time frame areas or an opposing level on a higher time frame. For the sake of this example, we're just gonna freestyle. Look at this over here. The market formed a new high. And then this is still your swing low. The market has to create a new swing low. And after creating that new high, you have these, I wouldn't say large imbalances, but then they're looking healthy enough for me, or healthy enough for them to catch my attention. So the market will eventually come back into this area to either find liquidity before continuing up, or to reverse on this level and go fetch liquidity here. Now look at this strong ARC candlestick. As soon as it printed, the market went back to fill in the orders that were left here, right? But then there's still a larger imbalance over here where the market eventually has to go back and fill in. So as you can see, orders here are filled and the market went for the order block. Look at how we are able to catch a nice entry on this area over here. Orders are filled. Someone might, okay, let me just leave this here. Now you still have orders that aren't filled from this area over here. That's where I'm going to be taking profit. Look at how the market went back into that area to fill in the orders. And then after filling in those orders, it reversed. You have a large candlestick here. Let me just remove this. Now there's a lot of unfilled orders here. The market will buy into this area over here and either grab liquidity and reverse, or the market will grab liquidity here and continue going up. So it only took a portion of the orders and continued to drop. Eventually, the market will come back and fill in the rest of the orders here. Now, as you can see, there's another imbalance over here. By the way, orders are filled here. This order block has been violated, so prices are dropping. Now you have another imbalance. Orders here are filled, as you can see. 80% ERC candlestick. The market has to eventually go back into this area to fill in the orders that are left here. Now we're going to be talking about how you filter out the sources of imbalance. They what we call supply and demand areas. In this instance, they called supply areas. This is also an area of supply, and this was an area of demand. Price will go back into this area to fill in 1 or 2. In this instance, this is an area where you will find your first opportunity. If not, this is a second best area because it's a discounted level. Orders are being filled small by small, but then on a lower time frame, the market is forming equal highs over here, right? So what can happen is the market can continue to drop because it has failed to break above this area, or retail traders could be lured into placing sell orders on this area of resistance over here, and then the market will come back, right, to take the liquidity from retail traders before continuing down. So what I see here is one of two scenarios. Either the market will either the market will drop or the market will retest this area, take the liquidity, retest this order block over here, continue down, or it will continue down from this area. So because there are two areas of supply that are stacked on top of each other, you place your limit order where it's a discounted level. Filled in the orders here. Is it going to fetch liquidity from equal highs? Yes. Took out stop losses? Yes. Filled in orders? Yes. Wait. So it took out the liquidity here. That's what I said. Filled in the orders here. Violated this order block here. Yeah. Let me just close. So you got an entry, the market went down, and now it looks like it's going to continue going up. Remember, there's still orders resting here, and the market can either grab them and continue going up, or the market can actually reverse. This is a perfect example of what I was talking about when I was talking about Marubuzo candlesticks. Look, there are two of them, right? And this is the source of that movement to the downside. Now, the market will eventually fill in the orders that are resting here. It's already filled in the orders that were unfilled on this. Still has to fill in the areas here. Currently, the market is trying to fill in the orders that are resting here. So let's see. This was actually a very good trade. The market came in here, filled in a few orders. There's still a few orders that are resting here, but then the source of that imbalance, the source of that area triggered a few limit orders, and then the market continued to drop. Market makers respond to customer supply and demand. Meaning that if they wanted to sell, for example, if market makers, they have to have so they need to generate patterns. Let's say they have their orders resting here. They will have to generate buy orders that will come into this area. And as soon as the buy orders that are coming in here aren't no match for the resting sell orders that are here, prices will drop. Then they will be able to sell profitably. That's what I wanted to say. That's what I wanted to say. Now, price will generate a pattern. The market will generate a pattern that will make sure that orders eventually go back into this area, and then we can get a drop. Also here on a lower time frame, you have a break of structure. Okay. And also you have this imbalance over here, or area of supply. The market will go back into this area of supply, assuming, because you have this break of structure, assuming that the market doesn't go all the way up. We also have another Marubuzo candlestick here. The market eventually went back to fill in the orders that were here. With this large ERC candlestick, the market eventually filled in the orders that are here. This is all you need to know when it comes to order blocks and also imbalances. The market eventually goes back into these areas to fill in the orders that are resting there. So in conclusion, remember this graph, or remember this. The market has memory. It will eventually revisit this area. Remember the lesson on market manipulation, right? You need to generate enough liquidity from retail traders to be able to trigger your orders. These are the signs of the imbalances. This is the strongest type of imbalance you'll find in the market, second strongest and third strongest. Obviously, you have to, if you make note of where you found high impact news, you will obviously find it. Now, where are we going to place entries? At the sources of these imbalances. And then how do you filter out this is all I have for you guys today. If you watched till this point, thank you for watching. I hope this made sense. And I hope you enjoy the series. Now, if you still have a lot of catching up to do, make sure that you watch my other videos. Subscribe to the channel if you still haven't. And I'll see you again in another video. Peace.